The market is driven by confidence. Now, how would you gauge the level of confidence that the market recorded in the last year?
I think the Nigerian market has gone away from those periods where we have a huge dose of distrust. We don't have that anymore. We've also moved away from that market where you did not trust why you were buying shares or whether you were trading in it. We've gone beyond that. The real issue about the confidence in the market has to do with confidence in the economy by extension. And so the market is bearish, absolutely bearish, and for good reason too. We're moving into the January effect, which means it will be further bearish. We're going into election with a huge dose of uncertainty. One thing the market does not need is uncertainty. You have a very, very high incidence of uncertainty right now. So, and as such, that impacts on confidence.
Now,
but having said that, most of the fundamentals hitherto have not changed significantly. However, if the pressures on the oil and on the revenue and on government spending continues without any clear direction or indication or positive indication being given from the Ministry of Finance or the central bank, you will find out that it will affect the core fundamentals, and then we have a bigger issue there.
What are comments on state governments that approached the capital markets in 2014 to raise bonds?
It is curious when you want to raise bonds when you have less than a few months left in office. But it's also possible that those are timing issues. I do believe that beyond politics, our history of how those bonds have been managed over time meant that the Securities and Exchange Commission would have to take some form of decision, perhaps delay approval over time, and which seems to be the case. Our concern is that I hope that is communicated to everyone and we understand. But if you look at the total effect of all these bonds we are creating, you will see the huge crowding out effect on the private sector. For example, if you look at the latest results from SEC, show you that I think about 150 billion is in corporate bonds, and we have about 556 billion in state government bonds already, which has been approved. That goes to the totality of the bonds. When you look at it vis-a-vis the ability of these states to service the bonds, there's a limit to which you can go. And there's a particular state, Lagos State, for example, which you think has borrowed quite significantly. At some stage, you cannot come back to the market and seek for more funds from you, because then you are asking where are the resources for which you want to pay back those things. And it's very good, he services debt, but there must be a tolerable limit to which debts you're servicing vis-a-vis the revenue. You have your revenue is basically made of two sectors, basically here now. You're getting taxation revenue, and then perhaps you're getting funding from federal government. The funding from federal government will most likely have to dwindle or be scrapped at some stage, and then you'll be left with that taxation. And if the people are not engaged in active commercial operations, they can only pay up to a level. So that means SEC also has done a good job in trying to educate the states to understand that there's a portion to which we cannot allow you to expose yourself far much more than that. We always wanted state governments to approach the capital market as a source of funding, but there must be some level of risk management involved in it. And I do believe that is the direction in which the Securities and Exchange Commission is going.
The tenure of the DG of the SEC, Mr. Ruma Ote, ended on December 31st, 2014. What do you make of the tenure in terms of the ups and downs?
Given the entrenched interest in the market, given the approach to which the issues that were on ground were so grave, and given some of the actions taken by SEC which riled a number of people, given the development you see in terms of initiatives, market confidence, regulations, the master plan, outstanding issues from the financial crisis which have been dealt with, it's a belief of most people that you would say that what has been done needs to be commended. In spite of the opposition, in spite of the hardship, there has been measurable and what you call not just achievement, measurable strides, whereby you see that the market is moving in terms of some few key indicators, you mean enforcement, regulation, new products in the market, development. But then there are also some few challenges that are available. Now, it would seem like a struggle to say that the market has done exceedingly well. But for me, I find comfort in knowing fully well that if a choice had to be made today as to what needs to be done, I do not, with all sense of modesty, I do not believe it would be inappropriate if the Securities and Exchange Commission is asked to continue with what they're doing, subject to them changing both their approach, attitude, and context in which they engage the market. There are a number of issues, some of which I've enumerated in some of my positions in public, which I believe they need to focus on. But that should not preclude the fact that as a market, we have inched far away from the abyss with which we sunk. And that needs to be acknowledged. And that very much is why I'm convincing myself that whichever way the decision goes, you will not ignore that the last 4 years have seen a quantum leap in terms of how we conduct regulation in the market. There are people who, for very good reasons, believe that, oh, we could have done better. But then again, hindsight offers people the benefit of looking as if we're smarter. Because I wasn't sure anybody had any magic wand in 2010, 2009, when we were dealing with all this crisis. I do believe there are certain people who feel very strongly that there are issues from that period which are still unresolved. Yes, and they have very good reasons to feel that way. However, we should move on. And we should find a new means of re-engaging. We're going through a difficult period for the market, for the economy. And the least we need right now is to go back to those petty issues that have nothing to do with where the market needs to head towards. And as such, we can engage. These are people who are proving to themselves to be professional. And this is a market of very highly industrious and ethically driven men and women.
You don't envisage replacements this year?
I don't see why we can't continue with what we're doing. If it therefore comes, that's a decision of those who should make it. I'm sure in their best judgment they would have other reasons. Don't forget that these decisions are not just decisions based on just scorecard. I'm just assuming that if it was based on scorecard, we're okay. And you know, they're very credible, thorough professionals all around the place who can actually do a good job. But if you ask me my own position, I say she should continue.
Now, there's been a challenge of liquidity in the market. I'm sure that the index is a reflection of how the market's liquidity is. Mm-hmm. How do you think this can be addressed in 2015?
Those who have answers to those questions would actually be the ones making the most money in this market right now. But one is to understand that the foundations for which the growth can take place have been laid by the NSE and the SEC and by players themselves. We could not do fresh IPOs, but we tried even to do rights issue. Did you see how we dialed it back once we had the valuation and the change in the oil prices? Everybody dialed back because where are you going to get the funds from? You can only grow so fast your economy. The market cannot be bigger than its economic size. So maybe the first few things we can do, which are easiest thing, is to do the damn thing we've always thought should be done. Put legislation in place to make sure that the economy is reflected in the market, i.e., find your growth areas, find your target area, bring them into the market at least. At least people have much more in there. That is something within our control. That is not subject to external controls. And those are the things, and we've been talking about it for the past 4 years. I believe the inevitability is now upon us to act. And those are the easy things we can do. Your telecoms, for example, and I know they would resist it, but they must understand that they do the same in Kenya, they do the same in other African countries. And the NSE, I understand, is not even making it a matter of compulsion. He is saying that, look, as a market, in my market, please, we can offer incentives, and it's discussing with the regulators, who I believe are in turn discussing with the legislators, who are saying, look, it makes common sense for every one of us. If you come into the market, at least you can at least start off with 25%. Maybe they'll make some exceptions for them. Start off with 25% and you go. You look like a company like Olam, who's quoted in Singapore, but it's not the Nigerian market. Yet he wants to enter the Nigerian market, but maybe certain issues requiring listing, requiring publicity, competitive activities. Maybe it's high time the NSE and the Securities and Exchange Commission begins to look at those issues again on the other side to say, what are these companies' concerns in a highly competitive market about they preferring not to list?
On a final note, how do you think the market will play out in 2015?
If what we expect happens, i.e., that there are no positive action taken from the policy side, and the parallel market rate of the dollar moves far higher than 240, and yet the MPR is not adjusted downwards to create incentive for people to be able to access money, the market will reflect almost the same gloomy outlook that we see right now.
At this point, I'd like to thank you, Mr. Femi, for your time with us on the show.
Thank you. You're welcome as well.